Hey everyone, today I want to share with you a few tips on how to avoid taxes legally. My legal disclaimer is that I am just an accountant guy. I do encourage you to speak with your accountants. If you don't have one, then I hope you enjoy this free information. Now before we dive in, here's my request. If this video helps you save money, then enjoy that money. Treat yourself, do something fun, or even help someone else. Just don't let the IRS take more than they need to. For 2025, if you're making under $460,000 a year, this video is perfect for you. If you make over $460,000, there are more tax strategies available. And if you're at the 1 million plus level, that's when things get more complicated. But today we're keeping it simple and practical for people making under $460,000. And just so we're clear, there's no magic trick to wipe out your taxes completely. What I'm sharing today are 100% legal ways to lower your taxable income, pay less to the IRS, and keep more of your hard-earned money. Let's get started. Number 1. Commuter benefits. It is a tax-free money for getting to work. Does your employer offer commuter benefits? If so, use them. For 2025, the limit is $320 per month tax-free. That's $3,840 per year. What's covered? Public transit, Uber, Lyft, parking fees? Check with HR. You might already qualify without knowing it. Number 2. Max out your 401k or 403b. The contribution limit for 2025 is $23,000 or $30,500 if you're 50 plus. And every dollar you contribute reduces your taxable income. If your employer offers a match, maximize it. That's free money. Number 3. Use a health savings account. It's the best tax-free account. If you have a high deductible health plan, you qualify for a health savings account. Here is the contribution limit in 2025. Single, $4,300. Family, $8,550. And if you are 55 or older, you can add another $1,000. These contributions are tax-free, the money grows tax-free, and withdrawals are tax-free for medical expenses. Here is the bonus tip. You can invest HSA funds and let them grow tax-free like a retirement account. Not all HSA accounts let you invest. So choose a brokerage like Fidelity HSA. They have low fees, full investment options. Lively HSA. They also have no fees, easy platform, and HSA Bank plus TD Ameritrade G. They have great investment choices. Number 4. Flexible spending account. This is a pre-tax money for medical expenses. For 2025, the limit is $3,200. Use it for prescriptions, co-pays, dental, vision. Warning: if you don't use it by year-end, you might lose it, unless your employer allows rollovers. Number 5. Dependent Care Flexible Spending Account. It is a tax-free childcare. For 2025, the limit is $5,500 pre-tax. This covers daycare, preschool, after-school programs, babysitters, adult daycare. Number 6. Capital losses. You can turn losses into tax savings. If you lost money in stocks or crypto, you can use those losses to offset capital gains. You can deduct up to $3,000 per year from your regular income. What about the extra losses? You can carry them forward to future years for even more tax savings. Number 7. Long-term capital gains. You might pay zero tax on investments. Hold stocks or crypto for at least a year before selling, and you'll pay a lower tax rate. For 2025, there is a 0% tax rate limits if you are single and earn under $47,025. You will pay $0 tax on capital gains. And if you are married and earn under $94,050, you will pay $0 tax on capital gains. Sell at the right time, and you could pay zero taxes on your profits. Number 8. Review your 1099-B tax form. You might be able to avoid overpaying taxes. Your 1099-B from your brokerage details your stock activity. But there is a big mistake people make that they didn't pay attention to. If your cost basis, by price, is missing, the IRS assumes you bought it for $0, meaning you owe more tax than you should. So make sure you double-check your form and correct missing cost basis info before filing. Number 9, margin interest deduction. This is a hidden tax break that a lot of people don't know. If you borrow money, margin to invest, you pay interest on that loan. That interest is tax deductible. Here is an example. If you borrow $10,000 on margin at 8% interest, you pay $800 in interest for the year. If you claim the deduction, you subtract $800 from your taxable income equal less tax owed. Most people don't realize they can deduct this, so check your 1099-B tax form for margin interest paid and claim it. Number 10. Minimal rental use rule. The Airbnb loophole. If you rent your home for 14 days or less per year, that income is 100% tax-free. Example. Rent your place for $500 per night for 14 nights. It means there is a $7,000 tax-free. Number 11. Roth IRA conversion lets you move money from a traditional IRA to a Roth IRA, so you can withdraw it tax-free in retirement. But there's a catch. You have to pay taxes on the converted amount now. So when does this actually make sense? For example, let's say Emma is 40 years old and currently in a lower tax bracket than she expects to be in retirement. She has $50,000 in a traditional IRA. Right now, Emma is in the 12% tax bracket, but when she retires, she expects to be in the 22% tax bracket. If she leaves her money in the traditional IRA, she will pay 22% taxes on withdrawals later in retirement. Instead, Emma decides to convert $10,000 from her traditional IRA to a Roth IRA this year. She pays $1,200 in taxes now, 12% of $10,000. But after that, the money grows tax-free and can be withdrawn 100% tax-free in retirement. Why is this a great move? If you expect to be in a higher tax bracket later, converting now locks in a lower tax rate. Once the money is in a Roth IRA, you never pay taxes on it again, ever. Roth IRAs have no required minimum distributions, so your money can keep growing tax-free for life. So the question is, when should you do a Roth conversion? If you're in a low-income year, for example, job change, sabbatical, early retirement. If the stock market is down, so your IRA balance is lower, reducing your tax bill on the conversion. If you expect tax rates to increase in the future, which is likely, you can convert small amounts each year to avoid jumping into a higher tax bracket. Moral of the story? If you expect to be taxed more in retirement, consider paying a little now so you pay nothing later. By the way, many high earners assume that Roth IRAs are off limits to them, but I've got great news. There's a completely legal tax loophole that allows you to bypass the Roth income limits. It's called the backdoor Roth IRA. I've linked that video up here and in the description below if you want to dive even deeper. But in this video, I'll walk you through the process step by step, help you avoid common mistakes, and show you how to grow your retirement savings tax-free. Now, let's get back to number 12. Invest in municipal bonds. You can earn tax-free interest. Interest from municipal bonds is tax-free at the federal level. If you buy bonds from your own state, you pay no state tax either. Number 13. Start a side business. You can deduct expenses. If you freelance or have a side hustle, you can write off expenses like internet and phone bill, office supplies and software, business travel and meals, home office if used exclusively for work. Even if your business is small, these deductions add up fast. Number 14. Move to a no-tax state and you will pay zero state income tax. Here are some states don't charge income tax, meaning you keep more of your paycheck. Here are no state income tax in 2025, Texas, Florida, Nevada, Tennessee, Washington, Wyoming, South Dakota, and Alaska. If you work remotely, moving to one of these states could save you thousands. There are tons of ways to legally reduce your taxes. You just need to know the right strategies. This way, you can keep more money for yourself and family. So which strategy do you use? Let me know in the comments. And if this helped you, subscribe for more tax-saving tips.